Well, first, I would say we'd shop, so we do like them. Risks creeping up. The biggest risk has been the market rotating more cyclically, so risk has been on. That's been the biggest risk. We think they invested appropriately in their business. They're taking market share. We think the outlooks for earnings next year is decent. The biggest risk then is if they decide to lean into price. And this has not been their posture for the last, call it, year or so as costs have been rising. That to us is the biggest risk. But they've been gaining high-income consumers. We think they're gaining share among low-income consumers. And there's a lot of catalysts along the way for this story.
That's interesting. So if they start going back to, real aggressive price cuts, kind of a Tesla strategy that obviously wouldn't like that in the near term. Melissa, was it last quarter? When was it last quarter that these names came out and kind of really shocked markets to the downside, or am I imagining things?
Walmart has actually been one of the outperformers in a lot of cases because it's been talking a lot about its grocery strength and then also leaning into alternate revenue streams. So that has helped it outperform in some cases, whereas Target has put up weaker numbers and also struggled with more excess inventory. So Walmart's grocery strength has really helped it during this period. As Simeon mentioned, they also have picked up a lot of higher income consumers because of those lower priced groceries.
Is there, Simeon, real quickly on this, a risk that as inflation erodes somewhat, they actually lose that trade down, that high income consumer who says, okay, well, now I don't really, psychologically, I don't have to shop at Walmart, I can trade back up?
Yeah, I'm not that nervous, or we're not that nervous about that happening. We'll see what happens, but it feels like the consumer could get a little bit weaker. But it shows that if they've picked up the higher income consumers, that should make them a little bit more sticky. We think this environment is ripe for them because they can pull share from all directions, from the high, even from the low.
All right, fair enough. Let's turn to one, a little more of a split on the street about it. Home Depot, Evercore with a warning about this one, saying that the increase in mortgage rates, falling existing home sales, and falling home prices are all softening expectations here. You're a little bit more positive, Simeon, saying maybe EPS could still beat. Why is that?
So I would say this is a structural shock for us. Tactically, it is going to be a tricky setup. First, home improvement broadly, a great sector, great industry. Home Depot, one of the best retailers in the world. The question is what happens to home improvement demand over the next 6 to 9 months. Historically, well-known correlation between existing home sales, which have been slowing, as well as home price appreciation and home improvement demand, which should also slow. Home prices started to slow about 6 to 7 months ago. And if you look at the letter of the correlation, you're probably in the next 1 to 2 months going to start to see a more precipitous slowing. We're starting to see it in the retail sales data, where sales are growing low single digits, and that's a little bit lower from the high single digits earlier. So we know this. We know in about the next couple of quarters, we're going to see some tougher comps. The question is, or what we've been willing to do, is to look around the corner because we think the landing is going to be somewhat soft.
Right, absolutely. Looking at the stock, Melissa, and again, we're about $40 off the 52-week highs. For one of the biggest pandemic winners, it's no Generac.
I think something to think about with Home Depot is it has an upside and downside scenario. On the one hand, the downside is that people may look at the higher interest rates and say, I'm not going to move this year. The upside is potentially they still shop at Home Depot or hire a contractor to say, let me fix up the home I'm in rather than moving.
Right. I thought there'd be a bigger tailwind from that. But again, lumber prices are down. It's just, Simeon, I'll actually ask you to comment on that kind of vis-a-vis Lowe's as we turn to that one, because their competitors also on deck next week. The stock up more than 5% this year. This one sounds like would still be a shop for you, but I am curious what declining lumber prices, as I mentioned, kind of what's going on with Generac. I mean, why isn't there more of a sustained tailwind for these names here?
Yeah, look, I put Lowe's very similarly in the bucket of Home Depot. They're both susceptible and prone to the macro. They're macro plays at this point. Lowe's has a lower EBIT margin. Lowe's has a lower PE multiple. That could explain the, let's say, relative outperformance. The market is just hiding in it. And what Lowe's demonstrated, they had an analyst day in December, is that they're willing to protect the bottom line and more confident than they've ever shown that during a down cycle. So the market took that confidence, or as a sign of confidence, that the durability of earnings may be a little bit better should we see a more pronounced cycle.
They're trying to hold the line, Melissa.
Margins are a big story for all these retailers going into the coming quarter, because if sales do slow, it's one thing they can point to and say, hey, our margins look healthier, even if our sales look a little weaker or aren't growing as much as they used to be.
Right. All right. We'll listen for commentary on that. And that brings us to Target. You mentioned it briefly a moment ago, but those shares actually up 15% this year, about a third off their highs. And I don't know if equal weight fits into shop or drop, Simeon. So you might be forced to choose here.
How about window shopping?
Okay.
I mean, we're interested. Our bias is to the long side, but we are equal weight. The intrigue with Target, a great consumer brand. They have demonstrated great acumen around omni-channel. They had some setback last year. The margin contracted significantly, down to 3%. This business normally punches at a 6% margin. We think there's a snapback, but there is some hesitancy. Their sales per foot grew 36% from the pandemic until now. That's a lot. There's a lot of inventory in the off-price channel. Amazon is taking incremental share again. These are some headwinds that could prevent the recapture of that margin in a quick time frame. And we think the stock is pricing in somewhat of this recapture already.